If you're counting on Social Security for retirement, what I'm about to tell you will completely change how you plan for 2026 and beyond. 10 massive changes are coming to Social Security this year, and number 7 is so controversial that Congress tried to bury it in the fine print. Some of these changes will put more money in your pocket. Others, they're going to cost you big time if you don't know how to navigate them. Whether you're already receiving benefits, planning to claim soon, or still decades away from retirement, these changes affect you. And here's the kicker. The Social Security Administration isn't exactly going out of their way to explain any of this. So stay with me for the next 15 minutes, because by the end of this video, you'll know more about your Social Security future than 99% of Americans. Welcome back to the channel, where we break down complex retirement topics into clear, actionable information you can actually use. I'm your host, and if you're new here, this is where we talk about the financial realities of retirement without the sugarcoating and without the sales pitch. Just facts, strategies, and real talk about securing your financial future. Today, we're diving deep into the 10 major Social Security changes for 2026, and I promise you, some of these are going to surprise you. Make sure you stick around until the end, because I'm going to give you a complete action plan based on your age and situation. Now let's jump right in. Change number 1, the cost of living adjustment, or COLA, for 2026 is 2.5%. Now, before you celebrate or complain, let's put this in perspective. For the average retiree receiving about $1,927 per month, this means an additional $48 per month, or about $576 per year. That's not nothing, but here's what they don't tell you. Medicare Part B premiums are also going up. The standard premium is jumping to $185 per month, an increase of $10.50 from last year. So if you're on Medicare and Social Security, that 2.5% COLA gets partially eaten up immediately. Your net increase is really only about $37.50 per month, not $48. This is the hidden tax that retirees face every single year. The COLA is supposed to help you keep pace with inflation, but when healthcare costs rise faster than general inflation, you're actually losing purchasing power. What should you do? First, track your actual expenses. Know where your money is going. Second, if you're still working and haven't claimed yet, every year you delay increases your benefit, which means future COLAs are calculated on a higher base amount, giving you more dollars in actual increases. Change number 2, the earnings limit for people receiving benefits before full retirement age is increasing to $23,400. This is actually good news if you're working while receiving early Social Security. Here's how it works. If you're receiving benefits but haven't reached full retirement age yet, Social Security will withhold $1 in benefits for every $2 you earn above this limit. Last year, the limit was $22,320, so this is a meaningful increase of about $1,080. Let's put this in real terms. Say you're 64, receiving early Social Security, and you pick up a part-time job. As long as your earnings stay under $23,400, your benefits aren't touched at all. But if you earn $30,000, you're $10,600 over the limit, which means Social Security withholds $5,300 from your benefits. That's almost half a year's worth of payments for some people. Now, here's the part they don't emphasize. This money isn't lost forever. When you reach full retirement age, Social Security recalculates your benefit to give you credit for the months they withheld payments. But in the meantime, you're dealing with reduced cash flow, which can be really tough. The strategy here is to be very intentional about your earnings if you're working and receiving early benefits. Consider negotiating hours or project-based work that keeps you just under that threshold. Change number 3, the maximum taxable earnings limit is jumping to $174,600. This is the cap on how much of your income is subject to Social Security taxes. If you earn more than this amount, you don't pay Social Security taxes on anything above it. This limit goes up almost every year, and for 2026, it's increasing by $7,200 from last year's cap of $167,400. What does this mean for you? If you're a high earner making over this amount, you'll pay an additional $446.40 in Social Security taxes this year. That's your share. Your employer pays the same amount. If you're self-employed, you're paying both halves, so that's $892.80 more. On the flip side, higher earnings that are taxed also mean higher future benefits because your benefit calculation is based on your highest 35 years of earnings. But here's the catch. The benefit formula is weighted to help lower earners proportionally more than high earners. So while you're paying taxes on more income, your benefit doesn't increase dollar for dollar. It's one of the progressive elements built into Social Security that most people don't understand. Change number 4. Full retirement age continues to increase for younger workers. If you were born in 1960, your full retirement age is now 67. This isn't new for 2026 specifically, but it's part of an ongoing shift that affects millions of people. Here's why this matters more than you think. Your full retirement age is the pivot point for everything in Social Security. Claim before it, and your benefits are permanently reduced. Claim after it, and your benefits increase by 8% per year up to age 70. The difference between claiming at 62 versus 70 can be as much as 77% more money per month. Let me give you real numbers. If your full retirement age benefit is $2,000 per month, claiming at 62 gets you only about $1,400. But waiting until 70 gets you $2,480. That's a $1,080 per month difference, or nearly $13,000 per year. Over a 25-year retirement, that's $325,000 in additional lifetime benefits. This is why understanding your full retirement age and building a strategy around it is absolutely critical. Change number 5. The substantial gainful activity amount for disability benefits is increasing to $1,690 per month for non-blind individuals and $2,860 for blind individuals. This is a big deal if you're receiving Social Security disability insurance. Substantial gainful activity, or SGA, is the threshold of earnings that shows you're able to work and therefore potentially not disabled anymore. If you earn more than this amount consistently, Social Security may determine you're no longer eligible for disability benefits. The increase from last year's $1,550 to $1,690 gives disabled individuals a bit more room to attempt work without immediately losing benefits. There's also a trial work period that allows you to test your ability to work for at least 9 months while still receiving full benefits, regardless of how much you earn. The trial work period threshold for 2026 is $1,050 per month. If you're on disability and you're considering going back to work part-time or testing your capabilities, understanding these numbers is crucial. You want to maximize your earning potential without inadvertently disqualifying yourself from benefits you still need. Change number 6. Spousal benefits and divorced spousal benefits continue under current rules, but more people are aging into eligibility. If you're married or were married for at least 10 years, you may be entitled to benefits based on your spouse's or ex-spouse's work record. The maximum spousal benefit is 50% of your spouse's full retirement age benefit. Here's a common scenario that plays out. One spouse, often the wife, worked part-time or took years off to raise children, so her own Social Security benefit based on her earnings record is relatively small, maybe $800 per month. But her husband worked full-time his entire career, and his benefit is $2,000. She can claim a spousal benefit of $1,000 instead of her own $800. That's $200 extra per month, or $2,400 per year. For divorced individuals, the same rules apply as long as the marriage lasted at least 10 years, you're currently unmarried, and you're age 62 or older. Here's the beautiful part. Your ex doesn't even need to know you're claiming on their record, and it doesn't reduce their benefit at all. A lot of people don't realize they have this option, especially divorced individuals who assume they have no claim on an ex-spouse's benefits. Change number 7. The taxation of Social Security benefits remains unchanged, but more retirees are crossing the threshold. This is the controversial one I mentioned at the beginning. Here's the deal. Up to 85% of your Social Security benefits can be taxed at the federal level depending on your combined income. Combined income is your adjusted gross income, plus non-taxable interest, plus half of your Social Security benefits. If you're single and your combined income is over $34,000, up to 85% of your benefits are taxable. For married couples filing jointly, that threshold is $44,000. These thresholds were set back in 1983 and have never been adjusted for inflation. Never. If they had been adjusted, the single threshold would be over $90,000 today. Because these thresholds haven't moved while everything else has gone up, more and more middle-class retirees are getting hit with taxes on their Social Security every single year. In fact, nearly 40% of Social Security recipients now pay federal income tax on their benefits. What can you do about this? Strategic Roth conversions before you claim Social Security. Roth IRA withdrawals don't count toward combined income, so having a substantial Roth balance in retirement can keep you under those thresholds. Also, consider the timing of other income sources like selling investments or taking large IRA distributions in years when you're not yet receiving Social Security or are receiving reduced benefits. Change number 8. The family maximum benefit is increasing to between 150 and 180% of the primary worker's benefit. This affects families where multiple people are claiming on one worker's record, such as a worker, a spouse, and dependent children, or a surviving spouse and children. The exact percentage depends on a complex formula, but essentially there's a cap on how much a family can collectively receive. For 2026, this cap is going up slightly due to the general benefit increase. Why does this matter? If you have minor children or a disabled adult child who qualifies for benefits on your record, knowing this maximum helps you plan. Sometimes it actually makes sense for the lower earning spouse to claim on their own record instead of a spousal benefit if it means the kids can get more, because the family maximum won't be hit as quickly. This is a complicated area, and if you have dependents who might qualify, it's worth getting a personalized analysis from the Social Security Administration. Change number 9. The work credit requirement remains at 4 credits per year, but the amount you need to earn for each credit is increasing to $1,730. You need 40 credits total, which is 10 years of work, to qualify for retirement benefits. Each year, you can earn a maximum of 4 credits, and for 2026, you need to earn at least $1,730 per quarter to get a credit. So you need total annual earnings of at least $6,920 to max out your 4 credits for the year. This mostly affects younger workers just starting out or people with sporadic work histories. If you're approaching retirement and you're not sure if you have enough credits, you can check your Social Security statement online. If you're short, even picking up part-time work for a year or two to get those last few credits can make the difference between qualifying for benefits or not. And for people who split their careers between countries with Social Security agreements, those credits might count too under totalization agreements. Change number 10. Online services are expanding, but so are security requirements. The Social Security Administration is pushing everyone toward online account management through the My Social Security portal. For 2026, they're implementing enhanced identity verification, including facial recognition technology and multi-factor authentication for all users. While this makes accounts more secure, it also means that if you're not tech-savvy, accessing your information is becoming harder. The SSA is reducing in-person services at local offices and shortening phone support hours, essentially forcing people online. If you don't have a My Social Security account yet, create one now while you can still do it relatively easily. The requirements are only going to get more stringent. You'll need your account to check benefit estimates, update direct deposit information, get tax forms, and eventually to apply for benefits entirely online. Also, be aware of scammers. The real SSA will never call you asking for your Social Security number or threatening to suspend your benefits. All legitimate communication starts with you contacting them, not the other way around. So, what should you actually do with all this information? Let me break it down by age group. If you're in your 20s, 30s, or 40s, focus on maximizing your earnings and getting those 40 credits as early as possible. Understand that Social Security will be part of your retirement, but don't count on it being as generous relative to your income as it is for current retirees. Build additional retirement savings aggressively. If you're in your 50s, this is the decade to get serious about your claiming strategy. Run the numbers on when to claim based on your health, family longevity, financial needs, and marital status. Consider working at least until full retirement age if possible, because those final high earning years can significantly boost your benefit calculation. If you're 60 to 62, you're in the danger zone of claiming too early. I know the money is tempting, but unless you have serious health issues or absolutely cannot work, waiting is almost always better financially. Every year you delay is roughly an 8% increase in your benefit. If you're already receiving benefits, make sure your direct deposit information is current, understand how the COLA affects you after Medicare premiums, and if you're working, watch those earnings limits carefully. Plan for taxes on your benefits and consider Roth conversions for future tax management. Here's my final piece of advice. Social Security is not a set it and forget it program. The rules change, your life changes, and the optimal strategy for you today might not be optimal 5 years from now. Review your Social Security statement every single year. Understand what you're projected to receive and what factors could change that amount. Don't rely on conventional wisdom or what worked for your parents or friends. Run your own numbers based on your own situation. And if you're married, run scenarios for both spouses and look at survivor benefits too, because whoever lives longer will be living on one Social Security check, not two. If this video opened your eyes to things you didn't know about Social Security, please smash that like button and subscribe to the channel. We cover Social Security updates, Medicare changes, retirement planning strategies, and all the financial topics that matter as you approach and live through retirement. Turn on notifications so you don't miss important updates, because as you've seen today, the rules change every single year, and staying informed is the only way to maximize what you've earned. Drop a comment and let me know which of these 10 changes affects you most, or if you have questions about your specific situation. I read every comment and I'll do my best to point you in the right direction, though of course I can't give personal financial advice through YouTube comments. Share this video with anyone you know who's on Social Security, planning to claim soon, or just trying to understand how this program works. Most people are operating on outdated information or myths they heard years ago, and that costs them real money. You can help someone in your life simply by sending them this link. And if you want to dive even deeper into Social Security strategies, check out the videos I'm linking in the description below, where we cover specific claiming strategies for married couples, divorced individuals, widows and widowers, and people still deciding when to claim. Remember, Social Security is the foundation of most Americans' retirement income. For many people, it represents hundreds of thousands of dollars in lifetime benefits. Treat it with the seriousness and attention it deserves. Know the rules, understand your options, and make informed decisions that maximize your benefits over your lifetime. 2026 is bringing changes, but with the right knowledge and strategy, you can navigate those changes successfully. Until next time, stay informed, plan smart, and make sure you're getting every single dollar you've earned. I'll see you in the next video.